of the things that is really interesting as well to me is how, in all of these environments, gold definitely stands apart than the commodities complex, even though it's part of the commodities complex and it's part of many commodities indices. It stands apart from, a demand perspective in terms of the dual nature on consumption and investment, but also on the supply side. You were talking about supply shocks and some of the effects that had in particular in 2020, right? And one of the things that one of the characteristics of gold is that in addition to mine production as a source of supply, you also have recycling. So, and it's also kind of like geographically diverse. So it was able to absorb some of the shocks, perhaps a bit more efficiently than other commodities. So it was not immune, but again, it was able to rise to that. And what is again interesting is that it can benefit to a degree from some of the cycles that commodities experience, but at the same time act differently, especially in periods of risk. And that's one of the reasons why while sometimes it lags, again it tends to catch up, and investors use it more for hedging than from a kind of like pure initial return perspective. And the other thing that was really interesting to me that you were talking about is ESG, and ESG definitely is top of mind for many investors. And again this is one of the instances where gold mining and gold in general it stands apart, in part because of that composition of demand and supply, and in particular, sorry, from a supply perspective, mine production and recycling, that gold is not just supplied through mine production, but actually it lasts forever, right? I mean, it's something that is not consumed, but it kind of like remains, and therefore the carbon footprint diminishes over time. And there's been a lot of research from that perspective. So I think that is really interesting how kind of like complements the broader perspective. So when people think about commodities, they may still think about commodities in the same vein, but there are differences on how they behave, right, and how they act, both from a supply and from a demand perspective, which perhaps leads me to my next question, which is, do you feel that the current geopolitical environment and inflation and also bubbling up conflicts that have been dormant for some time, and they're coming back now again to the forefront, do you think that they are more likely to affect commodities either from a supply or demand perspective in emerging markets or in developed markets, or how do we think about that?
I think in the emerging markets, it's clear that this high commodity price volatility is going to create some challenges, also potentially some opportunities. Now, if you look at developed markets, I would classify developed markets into two: those that have and those that haven't, right? The haves and the have-nots. The US, to me, would be the example of the haves, together with Canada's, and then maybe Australia would throw in that bucket, and New Zealand, and then the have-nots, which is essentially OECD, Europe, and Japan, Korea. And then if you split them into two, I mean, it's very clear that the developed markets that have the commodities, the raw materials, I think are going to be probably just fine, right? I mean, if energy prices go up, it's money going from New York to Texas. However, in the context of Europe or Japan, if commodity prices go up, it's money going from Paris to Riyadh, or from Tokyo to Abu Dhabi, right? So it's a challenging market environment for the developed markets that do not have raw materials. In that sense, I think geopolitics will impact some developed markets particularly badly. I mean, Europe is either in recession or very close to it. The US, on the other hand, is not, right? Japan is having to adjust through a rapidly weakening yen, while the US currency and the US economy isn't going through the same process. And then in the emerging world, it's a bit different, because in the emerging world, again, you have the commodity exporters and the commodity importers. Obviously, the biggest commodity importers, China. Biggest commodity exporters range from, obviously I mentioned Russia, but also you have others like Saudi Arabia are going to benefit, Latin America are going to benefit, so Middle East. The challenge, I think, for the Middle East in this particular case is that we are heading straight into a food crisis, and because of the importance of Russia and Ukraine in the global global agricultural trade. So if we end up indeed in experiencing food shortages, and again, this is not me saying this, is the United Nations is saying that food poverty is going to increase very dramatically here. Again, we know historically those periods of extremely high food inflation and lack of food shortages have led to political turmoil in places like the Middle East and North Africa. So I think geopolitics are not only important because of what's going on today between Russia and Ukraine, but they're also important because of what could happen next if we indeed are unable to feed the populations of North Africa, Sub-Saharan Africa, Middle East, which rely very, very heavily on the Ukrainian agricultural supplies. So that I'm more worried about that, to be honest, than I'm worried about other kinds of turmoil in emerging markets. I think China obviously is undergoing a slowdown, but it seems to me that it's relatively managed, and it seems to me that there's a lot of levers that the Chinese government can still pull to stabilize growth. Well, I think a lot of emerging economies, unfortunately, don't have that buffer and don't have those tools to stabilize their populations and their economic growth if they don't get the supplies of raw materials. So pretty distinct outcome as well between the different kinds of emerging markets here. I would say, probably break them into three types: the haves, the have-nots, and China, right? Just because China is so big and so distinct in the way it's positioned. So I think the haves will probably be fine for the most part, unless they end up running shortages on some key commodities. The have-nots, I think, are going to be experiencing the same issues that Europe and Japan are. And then China, I think, is slowing down, but in a more managed way, and certainly has a lot more tools than almost everybody else to cope with the economic downturn that is triggered, as we said, by the lack of quantities. We just have a quantity crisis, JC. We just don't have the volumes, and we don't have the inventories, and we don't have the spare capacity. So growth has to slow down to meet that limited supply situation that we have at the moment.
That's very interesting and insightful, and thanks for that differentiation. I think it creates a good framework to think about it. And so moving on a little bit to something perhaps a bit more recent, in particular in terms of the Fed and the last meeting. More generally, how do commodities perform in periods of rising rates?
That's a great question, and we've been making this point to our clients over and over for the last year and a half, telling them, look, inflation's rising. You got to own more commodities in your portfolio because commodities are the one asset class that performs well in rising inflationary environments. And people didn't want to believe a year and a half ago we're going to have inflation, and people didn't want to believe 6 months ago we're going to have inflation. And 6 months ago, people were saying, well, inflation is transitory. We have inflation, but it's transitory. And then eventually people capitulated and said, well, actually, we do have inflation. It's a problem, and we have to fix it. And that's kind of led us to the first quarter returns. If you look at the 60-40 portfolio, it's been a complete bloodbath in terms of equities and bonds. The only thing saving you in that portfolio has been your commodity exposure. So if you had some commodity exposure, you did a lot better than if you didn't in the last quarter, which again is the classic performance of commodities in a portfolio context. And I very much agree with you that you want to look at gold and the rest of the commodity complex a little differently. Commodities are very cyclical assets. Gold is a defensive haven asset, right? So they tend to be not particularly correlated, and they play a different function in a portfolio. And I think you need to have both. And here's where I get a lot of the pushback from our clients, because okay, fine, Francisco, I understand why you want to own commodities in a rising interest rate environment, because your equities are going down, because your bonds are going down, and because commodities are real assets and they have the shortest duration in your portfolio, right? Because you're consuming them every day, so there's no duration almost compared to your tech equity tech exposure or to your long bond exposure. Mm-hmm. But in reality, while commodities perform well until the end of the tightening cycle, and then obviously tend to come down quite hard, and therefore you want to have in your portfolio, gold is a bit of a different beast, and it's a different beast that I often get the comment, well, gold is not doing very well, Francisco, even though inflation is high. And I say, well, just remember that gold prices in signals from all different markets, prices in signals from interest rate markets, from commodity markets, from FX markets, and from volatility. And what's going on in gold today has a lot to do with a lot more to do with the strength of the US dollar and the higher interest rates than anything else, right? So it's not that gold is weak. Actually, gold relative to where the US dollar is and where US interest rates are, is actually doing pretty well. And it's holding in around $1,900 an ounce, despite the fact that the US dollar against the euro is at 105, the yen's broken 130. The treasury market is selling off in a very, very hard way. Now, to me, I like to compare gold to the yen. I like to compare gold to the euro, to the Swiss franc, if you like, or to a long bond Austrian, to a long Austrian bond, a 100-year bond. Look at how those are performing. They're not performing well at all, right? If you have very long bond exposure, and gold, again, think of commodities, you mentioned earlier, right? Commodities, on the one hand, have no duration, but gold, on the other hand, you said it before, lasts forever. So perhaps gold has the longest duration in our portfolio. And yet, if you think about gold in the context of every other long duration asset, every other haven asset, it's actually doing really well. And I think part of it has to do with the sanctions on the Russian central bank, and it has to do with the shift regarding property rights that we've seen in the West with regards to the assets of Russian oligarchs and the way that that they've been seized. So I think gold is doing well and is going to do a lot better once that the dollar strength ends. And again, I don't know how long that will take, but we do know that we are close to multi-decade record levels in the US dollar. And so we shouldn't look as gold being weak. We should look at gold actually doing pretty well in the context of multi-decade dollar highs and a huge sell-off in long bonds. That's the way I think about it.
Yeah, no, and I would agree. I think that it is important to understand those different drivers of gold. It's not just about, for example, interest rates is a combination of interest rates, but the dollar, and as you said, in particular, the strength that they have seen over the past couple of months, and how that has increased the opportunity cost and had a potentially negative effect on gold. But on the other hand, the flight to quality, the risk of perspective from some investors that is lifting up and providing some cushion, right, or some support for the performance of gold. And in the end, also, even though I agree with you that primarily gold is going to act, especially from an investment side, as a counter-cyclical asset, it still has some exposure to the kind of like long-term economic cycle through the consumer side. So it captures some of the jewelry, technology, and kind of like long-term savings, right? So that combination, it's really interesting. It sets it apart, and I agree that I think that gold has been performing quite well in spite of the fact that interest rates have increased, in part because of all other drivers. So thank you so much for your comments. Thank you so much for being here with us again, and we hope to see you again soon.
Thank you very much. A pleasure to be with you again. Take care.